people are infected with recency bias or normalcy bias, and that's the wrong thing to do, especially when you're 80 plus years old, thinking about playing shuffleboard and golf and retiring on your assets that, have been blown sky high due to suppressed interest rates and easy money. It's make-believe. It's Alice in Wonderland. And when you find an environment where those assets correct in terms of proper valuation, where price discovery is something that isn't such a mystery, then these retirees are going to be bagging groceries.
Renowned precious metals analyst and president of Miles Franklin Investments, Andy Schectman, has warned about the dangers of being excited about the current economic and market conditions in the United States, especially for retirees or investors that are only a few years or even months away from retirement. According to Schectman, the current environment is extremely unstable and highly speculative, making it a scary option for investors that need all the stability they can get. Schectman gives the example of two popular and successful investors, Warren Buffett and Michael Burry, who are currently either putting a lot of cash on hold or shorting the markets. Schectman explains that with classic value investors like Buffett refusing to enter the market at the moment, there's no reason why retirees who are heavily dependent on the returns on their investments should be investing in such an environment. Schectman also comments on people who take his warnings as just doom and gloom remarks from a salesman looking to sell his precious metals. He explains that he might be a salesman looking to make a sale, but that doesn't impact his honesty or intentions about warning people before it gets too late. We will now bring you important clips from Andy Schectman's interview with Liberty and Finance. Please watch, share, and like this video. Also, ensure you subscribe to the channel, turn on post notifications, and drop your comments and observations in the comments section below. Thanks and enjoy the video.
Well, there's the old saying, you can't get out of the way of what you don't see coming. And a lot of people, maybe even those that are well-read, are just reading the wrong things. But let's look at a couple of market gurus and look at what they're doing right now. Warren Buffett, as an example, has more cash stored on the sidelines than ever before. His Berkshire Hathaway has, between cash and short-term treasuries, a very short-term duration, is almost $148 billion sitting on the sideline. And he's known as the most classic value investor that there is. So he is anticipating greater value ahead. And it is my belief that if he thought there was such great value in this market, he would have all of that money deployed rather than being in short-term treasuries. And maybe equally as interesting, Michael Burry, the gentleman who called the subprime crisis, who had the book written and the movie made after him, The Big Short, just shorted the market with 93% of his entire hedge fund, $1.6 billion, shorting the market. So you have some very, very big players on opposite ends of the spectrum, a legendary speculator and a legendary value investor. Both of them are sitting on the sidelines in the respect of in cash or shorting what would be, and I guess it's not right to call Michael Burry on the sidelines. He's taking a more aggressive stance and actually shorting this market. And, you could also talk about this large, still inverted yield curve. And what the inverted yield curve is basically saying to guys like Warren Buffett, who have loaded up on short-term treasuries, is that the Fed, when things get really tight, will pivot and lower rates. And when rates lower, that means all of the the $147 billion in short-term treasuries that Buffett has will instantly go up in value as rates fall, and those bond prices in circulation go up commensurate. And so he'll be flush with cash, with the ability to come in and take advantage of whatever opportunities arise in the environment that is coming. And when you see a guy like him on the sidelines, I find it to be very, very ominous, at least in terms of what we could expect to see in the broader markets. And you look at it in terms of real estate holdings as well. The 30-year mortgage just hit 7.2%. That's just below its October 2022 high of 7.4%, or just under. It hasn't been this high really since 2000, 23 years ago. And we're also coming from a point where the values of the properties that people own have been blown sky high through a decade plus of suppressed interest rates and easy money. I would say the same thing about all the valuations that people are relying on to cushion their retirement. And when these valuations correct to meet a higher interest rate environment, to find equilibrium, they may fall a lot further than people think. And, you put it all together on top of, as we talked about last week, a growing mountain of debt, where just since the debt ceiling increase, the government has added over $1.8 trillion in debt, most of it used to reliquify the Treasury's account that had been squandered. And well, we did that in just over 8 weeks. It took the government 209 years to create the first 1.8 trillion. And looking at it on even a bigger lens, you go back to the end of 2019, before the pandemic, and we had $22.7 trillion debt at the end of fiscal year 2019. And here we are today, 32.7. That's 50% greater in just a few years. The acceleration of this debt and the rise of interest rates is really a big problem.
During his interview, Schectman discusses his opinions on the recent reports that Fitch might downgrade the U.S. banking industry, which would affect the credit ratings of the over 70 banks covered by the agency. During a recent exclusive interview with CNBC, Fitch analyst Chris Wolf revealed that the United States banking industry could face sweeping rating downgrades that could include even big names like J.P. Morgan. According to Wolf, the industry could lose its current AA negative rating and go a notch lower to A+, which would force the agency to reevaluate its ratings of all the banks it covers. Since an industry cannot be rated lower than the institutions under it, top-rated banks like J.P. Morgan and Bank of America will lose their top ratings, also going from AA negative to A+. Weaker lenders could also be pushed to non-investment grade status. Let's get back to the interview as Schectman discusses the brewing storms in the banking sector and how you should be investing in the current environment.
Then you throw into the mix, Fitch here today has said they're going to downgrade some more banks, including maybe even some of the big boys like J.P. Morgan. And when you see a banking industry that is being downgraded, a banking industry that, when you look at the regional banks holding 70% of all the commercial real estate loans and leases, and between now and the end of 2024, you have like a 1.6 trillion in these loans and leases that need to be reset. So as you see redemptions coming in with these banks or problems with these banks, and the banks are forced to sell their longer term maturity bonds, that's like a self-fulfilling prophecy. They sell them and those bond prices fall, but the yield goes higher as a result to attract more business or more interest in those bonds. And so it puts more and more and more pressure on the unrealized losses of these banks until, for whatever reason, they're forced to redeem depositors' requests for redemption, and they have to sell these bonds that are increasing in their loss profile. And that's why you still see such a huge amount of money in this new overnight or this new short-term bank lending program. The bottom line is that for people to think that all is okay, we are in the height of instability, of change, of risk. And I think anyone who would think that they've already reached their retirement and they're okay, certainly they're not thinking about their legacy. And if they are only thinking in terms of short term, look, things seem to happen on a dime. And when you talk about these banks that can overnight be bailed in, there's a lot to think about nowadays. And status quo, even the best laid plans done again, they need to be reevaluated from time to time. And in my 33-year career, I have never seen a more important time to reevaluate where you are personally on this crazy journey to retirement. You and I have said one phrase quite a bit over our last few talks, and that is recency bias or normalcy bias. People are infected with recency bias or normalcy bias, and that's the wrong thing to do, especially when you're 80 plus years old, thinking about playing shuffleboard and golf and retiring on your assets that, have been blown sky high due to suppressed interest rates and easy money. It's make-believe. It's Alice in Wonderland. And when you find an environment where those assets correct in terms of proper valuation, where price discovery is something that isn't such a mystery, then these retirees are going to be bagging groceries again and wishing that they would have not risked their retirement, really, to speculation in what amounts to maybe the most overvalued, over-leveraged, unstable, ultimately in terms of its fundamentals, set of traditional markets that I've ever seen in my career. So yeah, it's a question that you'll get asked, but most people are incapable of hearing. And even if you tell them, they'll think, you're just a doom and gloomer, you sell gold. Well, unfortunately, people have this opinion that capitalism, being someone who sells gold for a living, and honesty and good intentions have to be mutually, exclusive of one another. And yeah, you can be a great gold salesman, but your intentions are pure and your motivation is sound and logical. And, I would just simply say to you that most people, unfortunately, will not understand what you're saying until they see it with their own eyes. And by then, it's too late. So those who listen to you that reluctantly prepared, you're doing them a favor. And you look at the numbers, you look at the fundamentals, you look at the logic, you look at the history. In a world of probabilities, I would say that there is going to be a moment that will, as you said, catch many people off guard because they don't see what's coming straight at them. And you can't get out of the way of what you don't see coming.
What are your thoughts in Andy Schectman's interview? Do you agree that the highly speculative market is not the best bet for a retiree seeking stability and assurance? Please drop your comments and observations in the comment section below. Also, ensure you smash the like button and turn on post notifications for more videos. Thanks for watching.